G'day everyone, welcome to this weekend update, and this is probably one of the most important messages that I'll ever put out into the marketplace, and that is that I think it's really a time now, if you've never done it before, to consider putting some of your money overseas into the opportunities that are over there. Now I know for most people that's something that may not necessarily sit comfortably with you, but it's a very simple thing to do, and the opportunities overseas are just so much more attractive than what we've currently got here in Australia. So I want to look at that that particular theme in this week's update. So let's hop in and have a look. Just some overview comments initially. Central banks, with their actions of keeping interest rates at basically zero levels, and in varying countries providing different amounts of additional stimulus, are providing an extremely positive environment for stocks. Now that does lead to asset bubbles, and I'm not saying that that won't occur this time, because it will. But I believe that for various reasons we're still a long way away from those asset bubbles forming. And there are certain selected stocks in very clearly defined sectors that are rising not because of central bank policy, but they are rising because the fundamentals around their sector are incredibly powerful, are going to continue on for a long period of time. And in many cases, some of those stocks and sectors are still very cheap. Even though they may have gone up by 50% or 100% in the last year or two, the fact is that their growth rate in earnings is so strong that the share prices really haven't caught up to the fundamentals. So yes, central banks are providing an environment which is very positive, but which will become increasingly dangerous. But within that, there are stocks and sectors that are just going to continue on regardless. On top of that, we've also got, and this is just part of normal stock market cycles, sectors get out of favour. We've seen commodities and gold and silver in particular very much out of favour for the last 2 years after a decade of being very much in favour. So sectors go through cycles, they become hated, no one wants to know about them as the excess gets washed out of that sector, and then inevitably the supply and demand balance shifts back in favour of prices moving higher. And generally that starts when everybody absolutely hates the sector and no one wants to know about it, because at that stage basically all of the selling has been done. So there will also be some sectors that will move back into new bull markets, and they'll provide multi-hundreds of percent gains over the next couple of years. So that's the reality of where we are at the moment. There is still terrific opportunities if you know where to look. Now the key drivers for me, there are certain selected sectors that have got guaranteed huge momentum for at least the next 5 to 10 years, and that's irrespective of what central banks do or what governments do. Specifically in America, I'm referring to the shale and oil gas boom that is fundamentally changing the American competitiveness in the world. It's changing their economy, and it'll have a massive impact on the global energy balance. So that is a huge one, and that's not going to go away irrespective of whatever else happens. America's also making some fantastic improvements or gains in technology, particularly in the digital revolution area, also in biotechnology. So these are going to continue on regardless of what else is going on around the place. Secondly, these ultra low interest rates, basically zero in Europe, in America, in Japan, are here to stay for quite some time. And that makes the dividends from stocks really highly attractive relative to fixed interest. So the prices of assets are all relative to each other, and if fixed interest is going to be held at those incredibly low levels for so long, then it's going to force a lot of people into the stock market, because they're going to be chasing those dividends which are more attractive. Now, the other key point that I want to make here is that share price gains have not yet caught up to the growth in profits. A lot of people look at the look at charts and see that the share price of something has doubled or tripled and think that it's all over. But if the earnings growth is supporting those strong gains in price, then there's no reason why that trend can't continue. And whilst it's pretty hard to find great value in Australia at the moment, great value still exists overseas, and great value coupled up with some terrific earnings growth. Now, the reality is that you make the most money when two things occur. Firstly, when the earnings of a company or a sector are growing strongly and the fundamentals are set for that growth to continue. And secondly, you get what's called an expansion in the price earnings multiple. So a stock might be trading on a PE of 9, for instance, now, and as it becomes more and more in favour, then not only does the price move up with the earnings, but the price also gets an added boost because that PE multiple might move from, let's say, 9 to, say, 15. So that's when you make the most money in stocks, when you've got those two things together. And hard to do in Australia at the moment, but certainly there are terrific opportunities overseas to do that. Now, turning to the American market, the S&P index ended up rising 27 points on the week. Now, normal cycles suggest that we might get a bit of weakness for a few weeks or possibly a month, and then ongoing strength into year end. But I must say that this year and last year are anything but normal. The conditions we've got around the world created by central banks are anything but normal. So I'm just playing it basically as it comes. I'm expecting to see a little bit of a pullback, but it's quite likely that prices could just continue to move up. Now let's have a look at the S&P 500 index. You can see another solid week where every single session the index moved higher. It's become a little bit overbought again, but look, it's been up in this overbought area now for quite a long period of time. And you can see that the red line, the 150-day moving average, is still as strong as it has been now for the best part of 18 months. The index is as far above that moving average as it normally gets. So there is certainly no sign of weakness. Pardon me. So no sign of weakness in that index at all. So the people that are calling for a significant correction are really just wishing and hoping. They're not actually working on what is actually occurring. So if you can see here, we had back here in January, we had about 8 or 10 days down, and then the market went straight off again. Then in April, again, we got about 6 or 8 days down, and then the market just went up to new highs. This time we had a minor pause of 2 days. Now, I am thinking that we'll probably get another one of these instances like we had in April or in January, and this is certainly the time of year for that to occur. But that doesn't change the big picture. That's only the short term. We might get a couple of weeks down. But I believe that the markets will continue rising through the rest of the year, and certainly the selected sectors that I've been referring to, they will continue to outperform the main indices. Now let's just have a look at some of the internals within the American market as well. This is the NASDAQ index. You can see didn't do quite as well as the S&P last week, but still it's still pretty robust and no real signs of weakness. Now let's look at the Russell 2000. It's not at its all-time highs. It had a bigger dip through April and May, but nevertheless a pretty good week. In fact, it was really the strongest of the indices during that period. Moving on to the Australian market, the Australian index was higher by only 14 points. It's really disappointing performance. As I've been indicating over recent weeks, our market is being held back by predominantly two things. One is the concerns over China with their property market and their steel industry and the impact that that's having on the iron ore price. So that's having a filtering effect right through our market. And the second thing is consumer confidence is really pretty poor in Australia at the moment. that is impacting investor psychology, but it's also having an impact directly on business. We are seeing earnings downgrades and certainly some pretty cautious outlooks from the CEOs. So all sectors in the Australian market were under pressure last week. Even the banks are starting to struggle a little bit, and that's to be expected because frankly they're fully valued. They're probably more than fully valued at the moment. So let's just have a quick look at the ASX 200. So you can see we had a big reversal on Thursday, which some commentators are putting down to a bit of a short squeeze, bit of a sudden reversal and the need for the short sellers to cover their positions. But as you can see, more than half of that gain of Thursday was reversed again on Friday. So short term, we're in a downtrend in the Australian market. Medium term, it's really just going sideways when so many other global markets are actually pushing higher. So if you want to stay restricted to Australia, that's okay. It's all of a sudden not become a really bad place to invest, but it's just not productive at the moment. If you want to make money, then you've got to go overseas at the moment, and that's just the reality of the situation. Now, the great performers of the Australian market, the stocks that have gone up 100, 200, 300% over the last couple of years and reached pretty high valuations. Now, even those have come back. They're consolidating, but they're not bouncing as you would normally expect. They're just consolidating at a lower level. And even though those prices have come back a fair bit, it's still hard to find good value amongst those companies. There's a few, but by and large, it's harder to find value. And the ones that do represent some value are just really out of favour in terms of sentiment in the market at the moment. Turning to commodities now, gold was the big mover of the week. It gained another $38 on the week, so it's been 2 big weeks of gains, particularly in gold stocks. And I feel more comfortable that this time looks to be the real deal. I think we're pretty close to a new bull market in gold stocks. And one of the reasons that I say that is because gold stocks will normally lead the physical market by a week to 2 or 3 weeks. And in the past, gold stocks and the gold price have gone up at the same time. This time, gold stocks took off about a week before gold actually really got going. And the gains in the gold stocks have been more spectacular and more consistent this time. So I think this time might be the real show. Global gold stocks were the big movers. We had some gains in the Australian gold stocks, but again, inconsistent with the rest of our market, a bit disappointing. So global gold stocks, certainly the big movers overseas. Silver also rebounded, and that's something else that we haven't seen. Silver has not been outperforming gold over the last 6 months when we've had a couple of blips in the gold price. Silver went up by about the same amount or even a little bit less. This time, silver has really moved higher, and it's 11% up in the last 2 weeks, and it's going up faster than gold, so that's another positive sign. Copper gained some, back up to $3.10, so it's continuing to hold its gains, and the crude oil price was able to hold on to $107. That's largely because of what's happening in the Middle East. A lot of tensions and a lot of anxiety over in the Middle East. And this is the spot chart for copper. You can see we had a dip during late May, early June, but we've recovered those gains now. So let's take a look at gold. So this is the gold chart. This is on a weekly chart first of all. So you can see clearly we've got this phase 1 base. Let's just pan back and take a bigger look. So a very big run up, a very big phase 2 through here, peaked out in September 2011. We went into a lengthy transition phase, so phase 3, which lasted for the best part of a year. We then went into a phase 4 decline through 2013, which was a pretty ugly market for gold stocks. And then we've just been consolidating. So we're still within the phase 1 arena, so we really need to close above this 1440 level, but the signs are looking better. Let's move now to a daily chart of gold, and you can see a very big move on Thursday night and managed to hold those gains on Friday. Short term, it is a bit overbought, but as you can see back here, just put a crosshairs on that. If you can see back here, the last time we got overbought, the gold price still managed to move significantly higher again before it finally went into a bit more of a corrective phase. So we could see some further gains. I'd like to see it break out above 1330 and then, of course, successively move above these previous highs. Turning to silver, you can see the move in silver has been much more spectacular than in gold. So promising signs there. Let's look at the GDX index overseas. So big picture, still in a phase 1 base, but looking much more positive. You can see how many sessions closed on their highs and how many successive sessions closed on their highs. If you look back these previous periods, there was lots of ups and downs. There's a lot more conviction behind the move this time. And let's look at the junior end of the market, which is also showing a lot more promise. That was a very powerful 2 or 3 weeks in junior gold stocks as well. A little bit of a pullback on Friday, but that's to be expected. So just looking at it overall from a strategy point of view, I believe that you really need to expand your thinking and be thinking about getting some money allocated overseas. Members of Special Share Education, of course, have been getting this message loud and clear. Overseas is where the guaranteed drivers are in certain sectors, whereas most of the Australian market, there is certainly big question marks about how those sectors might perform over the next couple of years or even longer than that. Whereas overseas, there are sectors that really do look pretty much guaranteed. You need to stay with the strongest trends. There's a human nature tendency when something's gone up by 20, 30, 40% to think that it's all over. But the strongest trends will go a lot further than anyone possibly imagines. There will be continued great moves in America, but you've got to be highly selective about what parts of the American market and what stocks, because some stocks are outrageously overpriced, but equally there are still great value in America. We do need to look for a quick pullback in gold stocks. I think it's been a huge surge for over the last 2 or 3 weeks. The opportunities are certainly there, but you need to perhaps just wait for a little bit of a pullback in the price. Now, for anyone who's not a member of Special Share Education, I would encourage you to think about joining our group. You've got a couple of choices if you want to gain exposure to what's happening overseas. We can either help you do it yourself with specific recommendations and all the support you need to do that, or the other alternative is that I have a structure where I can do it for you. So the choice is yours, but I would encourage you very strongly to get some of your money working into overseas opportunities. If anyone would like further information or talk to me about the opportunities around the world, then that's our website address and that's my email address if you wish to contact me directly. That's it for this weekend. Cheers.